Usually, when people start researching tax-friendly countries, the EU is one of the last places that they think of. But the EU can actually be quite tax-friendly. And today, I'm going to go through two countries that you can opt for when it comes to your next tax residency. Hi, my name is Sadife and I have been with Nomad Capitalist for about 5 years now in the strategy department, helping people diversify their options. Today, what I want to talk about is some very tax favorable countries in the EU. Obviously, in the EU, apart from the two countries that I will be mentioning, there are many very favorable jurisdictions such as Malta, Cyprus, but specifically today I want to talk about Italy and Greece, and specifically about their lump sum or flat tax option. Now, in order for us to go through the details, we need to firstly make sure we understand what flat tax means. Flat tax, or also known as lump sum tax, is a single rate that is applied to the taxpayer regardless of their income. So what this means is that you could be making 1 million US dollars or 10 million US dollars, the tax will be the same in both scenarios. When it comes to the EU, Italy and Greece have wonderful lump sum or flat tax systems. When it comes to Italy, if you change your tax residency to Italy, you can actually qualify for the lump sum taxation, which is 100,000 euros for the main applicant annually. What this means is that it is irrelevant of how much you are making, you will still pay 100,000 euros as tax in Italy. Keep in mind that this tax is applicable only to non-Italian sourced income. So for income that is sourced in Italy, for example, it could be income coming from a real estate that you're renting in Italy, that will still be taxed on general rates based on the Italian tax system. But everything that is sourced from outside of Italy, irrelevant of how much it is, you're only paying 100,000 euros tax on that. In order to qualify for this regime, you need to fulfill two requirements. The first one is obviously to move your tax residency to Italy. And the second one is to actually not have been a taxpayer of Italy for the last 10 years. If you fulfill these two requirements, you can actually qualify for this particular regime. Now, what is important to note is that if you're considering of moving to Italy with your family, this particular regime extends to family members as well. So if you would be paying 100,000 euros in flat tax or lump sum for yourself, if you are moving to Italy with your spouse, you will need to add 25,000 euros for your spouse. So in total, for two people, it would be 125,000 euros. This regime will be available to you for 15 years. That doesn't mean that you cannot revoke it. You can revoke it at any time. But if you actually revoke it prior to the regime ending, it cannot be restored, unfortunately. The Greek lump sum taxation or flat tax is actually very similar to the Italian one. In the Greek tax system, you also need to pay 100,000 euros flat tax irrelevant of the income. What this means is that obviously income that is sourced from outside of Greece. If you have any locally sourced income, such as income from real estate, you will still need to pay tax on the usual rates in Greece regarding that. But any foreign sourced income, it will be taxed at a flat rate of 100,000 euros. The Greek flat tax, similarly to Italy, also extends to family members, but the difference here is that the added on tax that you will need to pay, for example, for your spouse, is 20,000 euros instead of 25,000, which was the case for Italy. This regime in Greece is available for 15 years as well. What I want to emphasize is that the lump sum taxation, both in Greece and Italy, or any other country that offers the lump sum taxation, pretty much, in order for that to work, you need to detach your personal tax residency from your country of origin and move it to the new country, in this case, either Greece or Italy. Obviously, this is not very easy for U.S. citizens because if you're U.S., you will be taxed at, on your worldwide income, irrelevant of where you're located. So you cannot really just detach the tax residency, similarly to what you could do for like Canada or Australia. If you are US and you're looking into moving to Italy or Greece and actually take advantage of this flat tax, you can just take a credit of the 100,000, meaning that you will not be double taxed because the US has a treaty with both Italy and Greece, but you're not really lowering your income tax. If you want to learn more about lump sum taxation, you can check some of our other videos where we go more in depth, not only about Italy and Greece, but some other countries as well. If you have any questions, you can always leave them in the comments down below and we'll be more than happy to answer them. And if you have any ideas or something that you want to learn more about, you can also let us know and we'll consider for future video filming. So thank you so much for watching, and don't forget to check out the other videos on our channel.